Bonjour and welcome to the investment portion of the Mtigo Min Trust Annual General Meeting. My name is Stephen Smith and I am with Presentation-Beutrel, the investment manager, and would love to be with you in person today, but unfortunately due to COVID restrictions, that's not possible. As we come out of this, hopefully we'll have the opportunity to get together in the not too distant future. In the meantime, I trust everybody is doing well and looking forward to the end of this horrible situation that we've all been enduring over the last year and a half almost now. I'm going to take you through a presentation today that's going to bring you up to date on what's been happening with the investment portion of the Mtigo Min Trust. I have the pleasure of working with a number of great trustees over the last few years. And in fact, since 2015, I've been working with Chief and Counsel when the portfolio was not yet in a trust. And in 2017 into 2018, the investment portfolio that was the Saukciun First Nation became the Mtigo Min Trust. So I'm going to take you through a presentation on what's been happening over the last while, show you performance to the end of 2020, and also bring you up to date to the most recent quarterly performance ended June of 2021, which is just passed, and also bring you up to date on what the current value of the portfolio is. And I'm sure you'll be quite pleased to see that the portfolio has done well. Certainly over the last year, there's been huge performance, and over the last 6 or so years since inception. So I'm going to start out with sharing my screen, and I'm going to reintroduce everyone to Mtigo Min. This is a presentation that I have started with in the past, but I think it's important to remind everybody of the investment manager and who we are and what we do. So bear with me as I bring the screen up. There, you should be seeing on the screen a Mtigo Min Trust Annual General Meeting. And I'm going to start, as I mentioned, with an overview of Mtigo Min, or a reminder of Mtigo Min. As many of you know, I've had the opportunity to visit with you on a number of occasions. And again, I always start out with a reintroduction of who we are and how we fit in the overall process. So Mtigo Min is an investment manager that is located in Toronto. We have the privilege of working with Indigenous communities all across Canada. We also work with pensions, institutions such as universities and hospitals, etc. And we also work with a number of families as well to help meet their objectives. So Mtigo Min was established in 1967. We manage about $45 billion, and we have about a little over 100 people working with our companies today. We follow something called a value investment approach, and I'm going to talk about that a little bit as we go along, but it's simply a particular way of investing in the stock markets and in the bond markets to provide good returns, but with a limited amount of risk. So we're focused on getting decent returns, not shooting the lights out, but getting good returns over the longer period of time, while reducing risk as much as we can. My name is Stephen Smith, as I mentioned a little bit earlier. I've been in the investment industry for over 35 years now. I'm a chartered financial analyst, and I have the privilege of working with clients across Canada, and in particular, have been developing Indigenous relationships for the last 20 or so years. So what we do, well, we create investment portfolios. And the idea of creating investment portfolios with the amount of money that is inside the trust is to use it to achieve objectives. We'll review those objectives as we go through the presentation. But the way we do it is we use that conservative approach, as I mentioned before. We buy good companies that are temporarily underpriced by the market. And as many of you are aware, the markets, the stock markets I'm referring to, go up and down in value over time. We are looking to invest in good quality companies whose prices have dropped for whatever reason for short periods of time. We buy these companies and then we hold them for typically a long period of time. So we're looking to buy good businesses at discounted prices, and to us as value managers, that's a good investment opportunity. And with that, we create in your portfolio a well-diversified portfolio that's got stocks, also known as ownership of companies. It's interchangeable. Stocks is the same as ownership in companies, or bonds. And bonds are basically lending money out to good quality companies, or lending money out to provinces or the federal government, for which we expect to receive a return. So in the stock portion, we have 25 to 35 solid US companies, the same amount in Canadian companies and international. So we're not looking to buy every company that's available in the world. We're looking to buy a select number of good quality companies and invest in good quality bonds. And by this way of investing, we are able to achieve the objectives. Now, we are well aware of how important environmental, social, and governance considerations are to the trustees and to the members of the Saukzing First Nation. And I thought I would add in this slide to give you an idea that of how we at Beutrel Goodman take environmental, social, and governance considerations in the investment of companies. So when we look at companies, we look at return potential. In other words, how well it's going to do going forward, from paying us dividends and part of its profits back, and how it will do over the longer period of time. But we also look at the risk side. And on the risk side, one has to take into consideration environmental, social, and governance considerations. So if the company is dropping the ball in this area of environmental, social, and governance, also known as ESG, this can seriously affect the longer term profitability of the company. So there's three areas: social, and that's when you look at things such as companies in Indigenous relationship record, for example, how it is current and how it's been in the past, and where it is going in the future. You look at things like diversity, community engagement, etc. On the environmental side, is their approach to climate change, and how do they generate power, and are there offsets for that, and they're looking at the environment. And then governance, how the company is actually managed, executive compensation, how the company is set up, how the board is set up, and make sure that they've got all the checks and balances in place for to reduce risk in the company. So these are very important when we are analyzing a company, and also looking at bonds that we invest in the portfolio. Now, I mentioned a little bit earlier objectives, and there are a couple of overriding objectives, and that is providing, number one is to provide for the needs of today, and number two is to provide for future generations. So providing for the needs of today, although there's not a lot of money that comes out of this particular portfolio, the portfolio generates, at the current time, the portfolio generates income. And when I mean income, I mean from dividends that the companies give us, pay us. And for those of you who remember, dividends simply means the company paying us some of its profits back in the form of cash. And we also look at companies going to grow over the longer period of time. But the dividend, or the interest that comes from bonds, and the dividends that come from the companies provide annual income that can be used for a number of social programs, also be used for infrastructure, cultural development, business development, etc. So although this particular trust is not taking a lot of money out right now, it's taking the money and reinvesting, and that's done quite well for your returns over time. The portfolio generates that annual income. Now, the other part that is just as important, in fact, some would argue even more important, is to provide for the needs of future generations. So the second objective, or sorry, the other objective, just as important, is to provide for the children of tomorrow and seven generations forward. So we create a portfolio that addresses the short-term needs as well as the long-term needs. So the idea is to provide growth in the portfolio. So we think of the trust investment money as a portfolio that over time will grow for future generations. And in the meantime, we're looking at it to provide annual income. So we look at the tree as having branches that provide fruit, and the fruit can be thought of as the income that is generated from the portfolio. So just going back for a second, the idea is to take this portfolio and grow it over time, and along the way to provide annual income. And this will meet the two main objectives of providing for the needs of today as well as the needs of tomorrow. But the idea is to have a balance in the portfolio. So you balance these needs and you diversify the portfolio in order to meet the objectives. So it's all about balance. So how do we as investment managers know what we're supposed to be doing? Well, how do we know where we're supposed to be investing? Because there has to be a plan. And so there's a document called the investment policy, which translates the objectives of the Mtigo Min Trust into a working plan to achieve the goals of the Saksing First Nation. So for us, it's a roadmap, and it's something that guides us on what the expectations are for the way the money is supposed to be managed and how we're going to achieve those goals. And each quarter, we provide a statement that says that we are doing exactly what we're supposed to be doing. So I mentioned the Mtigo Min Trust objectives. These are laid out right in the trust. So the financial objectives are to preserve capital, so safety of principal to provide for future generations, as I mentioned a little bit earlier, to provide that stable and consistent income that I mentioned as well, not to take too much risk. There will be no return in anything in life, particularly investment portfolios, without taking some risk. And so you'll see the portfolio from time to time go up and down in value, but we try to minimize that by the way that we invest. And part of the way that we minimize risk is through diversification. And that simply means that we don't put all our eggs in one basket. We don't invest all the portfolio trust assets in one company or one bond. We spread it around, and we invest in a number of different types of companies and a number of different types of bonds, because sometimes some companies will go up in value while others are going down. When you put them all together, they should provide good returns over the longer period of time without too much risk. And then finally, we're looking to achieve returns that are better than what you would get than just investing in your money in a bank account or in short-term bonds. I mentioned companies a little bit earlier. This is a sample of some of the companies in the US, Canadian, and international portfolios. And I've just taken a few of them to give you an idea that the companies that you're invested in are good quality companies. So for example, you'll see Campbell's. Probably everybody's had soup from Campbell's Soup before, and they make a number of different types of food products as well, as does Kellogg's, Canadian Tire. I spent a good part of my time at Canadian Tire, having bought a cottage some time ago. So I'm always at Canadian Tire, as I'm sure many of you are. Metro, that's the food stores, as is Loblaws, Kimberly-Clark for tissues and for a number of different paper type products. The banks, American Express, Rogers, Saputo Cheese, that's a Canadian company. So a number of good quality, Michelin tires, a number of good quality companies that your portfolio is invested in. And again, we look to invest in these companies for the longer period of time. So we're not just buying these and selling them a couple of days later or a week later. We're looking to invest for the long period of time. In the bond portion, these two pie charts just show you that there's a good quality bonds in the portfolio. So if you look at the pie chart on the right-hand side, you'll see a number of letters under there, triple B, A, double A, and triple A. And what that simply means is that the bond portion of the portfolio is invested in good, solid companies, and provincials and federal debt as well. And those letters simply are credit ratings. Just like any one of us have a credit rating when we go to borrow money, So do companies and provincial governments and the federal government. Federal government, of course, is a AAA. The AA is a lot of the provinces, and double A's and A's are the banks, and triple B is anything that is investment grade. So good quality bonds. And on the left-hand side, you'll see that in that dark blue part of the chart, that there are almost 60% in corporate or company bonds. So there's a good weighting in company bonds as well as provincial bonds. And we look to invest more in company bonds and provincial bonds because that gives us a little bit higher return than what you would get by investing just in a federal or Government of Canada bond. So we're looking to get a little bit more return, but not take on too much risk. So you've got a very, very good quality bond portfolio that the trust is invested in. I mentioned a little bit earlier the investment policy. Now, in the investment policy, again, that direction that the manager has for investing the portfolio, it lists the amount of each asset class that is targeted at a certain level. So, for example, we look at the bond portion of the portfolio being around 35%. We look at U.S. equities being at around 25%, Canadian equities at 30%, international equities at 5%, and cash, in other words, just short-term investments and money in the banking, as it were, to be in a certain proportion. But as managers, we are given the ability to work within certain ranges. So if you see that chart on the left-hand side, the bar chart, that's simply this this pie chart translated into a bar chart. So again, that's 5% cash, the bonds 35%, Canadian equities 30%, the US equities 25%, and international 5%. But if you look along the bottom here, you see 0 to 15, 25 to 60, 20 to 40, 15 to 40, and 2 to 15. What that simply means is that we as the manager can use our discretion to invest the portfolio somewhere within those ranges. So for example, cash, minimum that we're allowed to have is 0, and the maximum would be 15%. We're at 3% for this portfolio now. You'll see on the bond side, we have that range of 25 to 60. We're at 31% versus 35. So we're a little bit underweight in bonds and in cash, and together that's called fixed income, which bonds and cash. So we're a little bit underweight in fixed income, and we're a little bit overweight in equities. So we're pretty much equal weight in Canadian, a little overweight in US, and overweight in international securities. And the reason we do that is because that's where we see the best prospects for returns for the companies in the portfolio now. And that can change over time, but as of June 30th, 2021, that's where their portfolio is situated. So how have we been doing? Well, for the 1 year, and this is 1 year to the end of December 2020, the market was what we call very growthy. So a lot of the companies that did well were the Netflix, the Facebooks, Googles, those types of companies in which this portfolio is not invested. Not that because they're not good companies. We think they are good companies. We just think that they're a little bit too expensive for us as value managers to invest in. So while your portfolio had a respectable 6% return, the market was a little over 10% for the 1 year to the end of December. Now, what's happened since then is that your portfolio has done very, very well. So for the 1 year, it's 21.1% was the return from the end of June 2020 to the end of June 2021. So a huge return for the last year versus 16.5. So about 450 basis points, or 4.5% better than what the market did together, or what the benchmark did. For those of you who are not familiar with benchmark, a benchmark is simply a hurdle that the manager has been asked to exceed, and we've been able to do that. And the benchmark is made up of this number down here, which is 5% cash, 35% bond market, 30% Canadian equities, which is the S&P TSX, 25% S&P 500, which is the US market, and 5% MSCI EAFE. So what this number is 16.5, simply says if we were to invest in all the companies in the S&P TSX and all the companies in the US market, in the S&P 500, and all the companies in the international, as well as invested in all the bonds in Canada and the cash, that's what you would have otherwise received. And because of the way that we invested the money over the last year, you've received 21%. So a good return. So over the longer period of time, as I mentioned that we've been managing money for 6 or so years. In fact, the inception date when we first started investing the Wissahickon First Nation Fund before it became a trust was May of 2015. And again, that money was invested into the trust about 3 or 4 years ago. So since then, since the beginning, we have returned about 56%. So the money has increased by well over half. And that's to the end of June 2021, just recent. And the next chart is called the capital flow summary. So this tells us how much you started with, how much has been taken out, what the market value is today, and what the gain in the portfolio is. So the original contribution back in April of 2015 was $2,500,000. Over time, $114,700 has been taken out. And so if you simply take the amount that was contributed and the amount that was withdrawn, that gives you a net number of $2,385,000. The market value as of the end of July 16th was $3,633,934, which means the portfolio is up about $1.25 million since we started managing money for you. So I hope you'll agree that's pretty good return that has made over time. So I'm going to finish off with a couple of things. One is just a reminder of the compliance. I mentioned earlier about the investment policy. Everything is set out in investment policy. The asset allocation, if you look at the very top line, Canadian equities, minimum 20%, 40% maximum. And then each quarter, every 3 months, I sign off saying, yes, we're compliant with all this different requirements of the investment policy. And if for any reason we're not in compliance, and it does happen from time to time, not very, very infrequently, but if we were, then we would tell you why, and we would tell you that it's going to get back in compliance very quickly. But we, to the best of my knowledge, we've never had the portfolio out of compliance over the last 6 years. So where do we go from here? Well, the portfolio has done well over the last number of years, particularly in the last year or so. But that's against a background of a world economy that is beginning to improve. As we come out of COVID, things should be getting a little bit better. There's a lot of people with that have not been able to spend money because there's just hasn't been things to spend it on. People haven't been going out to restaurants or spending a lot because we haven't just been going out. Restaurants or vacations or buying new things. It's just all slowed down. That's beginning to pick up, and that's very good for the market overall, and certainly for the companies in your portfolio. So as things are improving, things are going to get better in the market. Now, things will go up and down from time to time. We'll have good times, and we'll have times that may not be as good. But as the vaccines roll out, we hope to get back to some sense of normal and things moving forward. The one thing that, one of the reasons this has been happening is the central banks, in other words, the Bank of Canada, the Federal Bank, and many of the central banks in countries across the world have been putting a lot of money into the system. So they've been keeping interest rates really low. They've been spending a lot. You've seen the programs that the government has been using to get money back into the economy, and this has worked out. It's worked out well. So going forward, it's the health of the market and the economy is going to be dependent on how the vaccine rollout continues to work, and on the growth of the economy that's going to result from a lot of pent up demand. Will there be a rocky road along the way? Yes, there will. But we think over the longer period of time that this company is very well positioned to do well, and to importantly meet those short-term and long-term requirements that are set out in the trust and in the investment policy. And we do that by having the Mtigo Min trust portfolio invested in a well-balanced portfolio that remains in compliance with the current investment policy, again, that will meet those long-term objectives. So I'd just like to say thank you in closing. I do look forward to getting over to see you in Wisconsin in the not too distant future, and hopefully that will be maybe in the fall, perhaps in the spring. But I can assure you that the trustees and investment advisor Kelly and myself, we all remain in contact frequently, and we are always working together to continue to meet the objectives. And I would like to say that it's a privilege to work with your team, and a privilege and honor to manage funds on behalf of the Wisconsin First Nation. So everybody, please stay well. I look forward to seeing everyone again soon. And if there's any questions, please let me know through the trustees, and we would again look forward to getting all together soon. So miigwech, take care.